Our next guest has been a longtime investor in the space and joins us now with some top picks. Harris Oakmark partner and co-CIO of International Equities, Tony Coniaris. Tony, first of all, I just want to ask you kind of the role that International plays right now in terms of diversification. I know going into the year, there was the whole argument about U.S. exceptionalism and how to kind of get more diversification abroad, especially given the increasing concentration in U.S. equities. Nothing's really changed there, except International has gone up so much from this juncture. So I'm just curious how you square all of that at this point in time.
Well, it's an important question. Thank you for having me. Based on the work we've done, it appears that the average U.S. investor has something like 8 or 9% of their portfolio in non-U.S. stocks. And when you look at the relative performance this year, those investors are asking the question, did I have enough of this? If you look at the academic research, it says somewhere around 30% of your portfolio should be in non-U.S. stocks, a U.S. investor. And that's kind of, if you look at the target date funds or other asset allocation models based on academic research, that's what they recommend and typically implement.
30% of your equities allocation or 30% of your portfolio?
30% of your portfolio is typical for the target date fund. So that's the allocation component of this. The big question we get is, U.S. international markets have been better. You cited the numbers. And is this going to continue? And you know, I can't predict what stock prices are going to do, but the ingredients are there for it to continue. And typically, these movements between U.S. and international markets go on for some time. The two most important ingredients are price and fundamentals. On the price side, international markets sell at a 32% discount to U.S. markets today. That average long term has been closer to 14%, so that's more than twice the average discount. I'm not saying that's going to correct overnight, but if it did, that's 2,600 basis points right there. And on the fundamental side, this is really important. If you look at the international market indices, take MSCI Europe, for example, at the beginning of the year, the outlook for earnings growth was 7.5%. Not bad, not great. Today, after the third quarter, it's up to 11.5%. The earnings expectations and performance in those markets has been increasing. The U.S. market, fundamentally, has been strong, but the earnings growth expectations on the S&P 500 have gone from 14% growth down to 13% growth. So the expectations for growth have moderated in the U.S., and they've been accelerating and growing faster outside the U.S., combined with lower overall prices.
What's driving that growth outside the U.S.? And I ask this because I guess the bear case that people have made for not investing internationally and just focusing on the U.S. is that there's so much innovation here as it pertains to AI and other growth areas. And so I'm just curious, is it tech that's driving the growth abroad? And where do you see the biggest opportunities right now?
Well, we're finding great opportunities in companies that we normally don't. So there is a quality on sale going on in international markets today. I can't tell you exactly why the earnings expectations have gone up, other than they were just too low to begin with. And if I had to guess, it goes back to your original comment of there was all this talk about American exceptionalism, Europe is dead, and I think that was reflected in the expectations of the companies in those indices, and now we're seeing the real performance there. There's also reforms. I mean, look at Germany. You know, they're announcing major fiscal reforms. They're going to start borrowing money and spending money. And, you know, these governments aren't sitting still. They want their economies to grow, and they're acting on it. But we're finding a lot of interesting, high-quality companies today, which is sort of unusual for a value manager with a strict criteria like Harris Oakmark.
And, Tony, what about outside of Europe? I mean, is it a similar story in places like Japan or other developed markets elsewhere?
Yeah, you know, the interesting thing going on outside the world is I would say there's a catch-up on corporate governance going on. So if you look at Japan, we've been talking about improving corporate governance, albeit at a snail's pace, since around 2010. And there's been some very important changes there, including a new Shareholder Rights Act this year. And then Korea is sort of playing catch-up to Japan. They have what they call the Value Up program, where the government is compelling companies to focus more on shareholders than chaebol, which has been the focus in the past. And that's a really good thing. We've all heard of the Korea discount. If you want that Korea discount to go away, one of the ways to do it is to start encouraging companies to focus more on shareholders.